Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I came across some information this week that I thought I'd pass along, and it's some good information. It's something that we don't normally look at, spend a lot of time on, but it's something that I thought this week was important to really kind of cover and go over. What this chart is showing is private equity and private equity activity in the market. And this is mergers and acquisitions is the black, and the purple is public offerings or public listings, companies that are going public. And what this shows is we have been over the last few years because of high interest rates. We have been below average as far as mergers and acquisitions and companies going public. What we're seeing in the first half of 2025 is those numbers have gone up significantly. And that's what I wanted to talk about. Why is that? Well, the market, there's, in the general overall feeling in the market right now is that we are in a pro business and declining interest rate environment. It makes it much more conducive to either going public or to have mergers and acquisitions. And that, in my mind, is a very good sign. And it's a good sign that companies and people out there, consumers, feel like the economy is going in the right direction. So I wanted to share a couple of numbers, just to kind of give you an idea and maybe talk about interest rates. Inflation as of right now is growing at about 2.7% per year. That's a little bit above what the Fed target is. The Fed would like it to be right around 2%. Last year at this time, we were at 2.89, and we've been holding steady right about 2.7 over the last 6 or 8 months. As of right now, interest rates, if you looked at a 30-year mortgage, and again, we've talked about this before, we're a little bit lower here in Utah, but the nationwide average is about 6.6%. The Fed fund rate is currently sitting at 4.33%. That's what banks get money from the Fed, how much the Fed charges them. So there's an argument going on back and forth where some people think the interest rates need to be cut. Other people think it needs to be either not really raised. I don't hear many people arguing for raising it right now, but I do hear people arguing to keep it where it is. There's two schools of thought. Number one is the Fed rate, or the inflation rate being at 2.7 is a little bit higher than the Fed would like. So one school of thought is leave it as is until those rates come down a little bit more. The other, well, but the fear of that, or that side of the aisle, the fear is that inflation rates will go up even higher than they are right now. The other side of the equation is, well, if we lower interest rates, then more people can afford homes and cars, and it stimulates the economy. So there's obviously been a battle in Washington, this kind of back and forth. The president would like interest rates to be cut, but the Fed has kept them steady, and we're still not quite sure what's going to happen going into the future because they want to make sure that inflation does not go back up again. So kind of give you a little bit of information here. The current Fed fund rate is 4.33%. The next Fed meeting is September 16th and 17th. The general overall feeling right now is that the Fed will cut rates. Whether that will be a quarter of a point or half a point, we don't know. And we really won't know if there will be a rate cut until they actually meet. But the general feeling on the street is that we're due for a rate cut. Will this be the only one? If it happens by the end of the year, we don't know. And that, I know that the Fed is continuing to watch that, and they're going to continue to bicker back in Washington whether they cut rates or not. But we'll continue to watch that. So what does all this mean? As we've been sitting down meeting with clients and going through portfolios, we continue to preach diversification. And I'll tell you one thing that we're very glad that we've done over the last couple of years is, as the international markets have not performed very well and the US markets have performed very, very well, we're glad that we've stayed disciplined, because that has just reversed over this last really about 6 months, where the international has really, really taken off and the US markets have not grown nearly as fast. So again, we continue to preach diversification. We want to watch all the indicators, and we really want to watch to see what happens with interest rates and those kinds of things, and how they're going to affect the markets and how they're going to affect your portfolios. Anyway, if you have any questions, please let us know. We have some good comments on the videos that we do, but if there's something specific that you would like us to address, we'd love to hear from you, and we'll get to those as we can. Again, thank you for joining us, and we'll talk to you again later. Bye.